Last we left off, we were on our handout number 13, kind of right in here, and I wanted to do an effective interest question. So for those in the room here, I passed out just a copy of this question, exercise 10-21. For those of you online, you can see it here. And all we're looking to do is just do parts A and B, and I'm going to walk you through that. All right, so I'm going to pull up the Excel and I'm going to create an effective interest table. Okay, while I'm walking around and making sure everybody has a copy of these, just draw a little set of boxes like that on your paper. Whatever code you're using. Put that up on there. Okay. Just gonna do one last walk around, make sure everybody's got the setup. All right, so looking at the question, it says on January 1 of year one, Bryson obtained 147,750 4-year 7% installment note from the bank. The note requires annual payments of 43,620 beginning December 31st of year one. So we're looking at it at the end of the year. And our carrying amount is 147,750. The note payment is going to be $43,620. And now interest is calculated at 7%. So what you want to do is you want to multiply your carrying amount by 0.07. And so that's 10,342. Now what you do is you take the difference from the payment, subtract out the portion that's going to interest, and the rest gets applied to your principal. So our carrying amount now equals our January carrying amount minus our decrease in the principal. So this is kind of how your car loan works, except for usually you make monthly payments on it. But you can see that we start out with a larger balance. Our note payment is going to stay the same throughout, and more of our note is going to go to the actual principal, and the interest will decrease as the principal decreases. Okay. So now we carry this part down from the end of last year. Our note payment is always going to be the same. And our interest is always going to be calculated the same. Okay. So again, our entry comes from, for our January carrying amount, comes from the December 31st carrying amount. Our payment's always going to be the same. Our interest is multiplied by the 7%. And then our note changes by the difference in what we paid versus the interest. And so you guys calculate out the last year. Sorry, this is shining so much light up front. Okay, so we carry our 4766 down. Tells us our interest is going to be 2854. And so here, the decrease in notes payable is going to be 4766 and 0. Okay, so does everybody have this? So this gives us all the information that we're going to need to do our entries. And so the entries are the next part that they're asking for. And so the first one is the note payable. So January 1. Oh, I put the date in the wrong column. We'll use 24 as the year. The description is cash. Wait, hold on. What did we get here? Was it just a loan? Yeah. Okay. So we got cash. And that was for 147,750. And our credit is to notes payable for 147,750. And then 1231/24, our entry would be interest expense. And what we would do is take that amount from our year 1 interest expense table. And then notes payable, we'll take that from our table as well. This is how much is going to reduce the principal. And that is going to reduce our cash. And that should be 43,620 barring rounding errors. There are going to be some rounding errors, so it's going to be $1 off here and there. Okay, and then we have 1231/25 interest expense. So year 2 now. I took the wrong one there. That's not 40,000. Don't take that one. So those are our entries. And you can see they're basically the same entry each year after the first year. And you can see that the interest expense is going down and more is being paid to principal until it's completely paid off. Any questions? I'll give you guys enough time to write that down before I jump into the sheet that we were using last class on Tuesday. Yep.
Make sure you have the order right. I think it's kind of how an expert format to
Mm-hmm.
A, B, then A times.
Mhm.
And then this is your note payment minus interest.
Mhm.
And this is just the carrying amount minus the. Okay.
Yep.
Just making sure. Thank you.
No problem. Okay, if there are no questions, we'll go back to that other worksheet. And I still have a couple left to hand out 13 if somebody was here that didn't get one. Okay, so the next section covers loss contingencies, and it kind of, they've moved in accounting things that we know are going to happen in here with kind of these things that have some uncertainties. So loss contingencies basically say if the loss is probable and you can estimate it, then you have to report it. And it's not really a loss in all cases, like warranty repair work is not necessarily a loss, even though it's covered under this framework. So the likelihood of a loss depends on two things: whether or not you can estimate it and whether or not it falls under one of these categories. And probable is that the future event is likely to occur. Now notice they didn't give you a percentage here. So if your analysis says, I guess more than 50%, that seems like it would be likely, but they don't give strict percentages like that. So it's kind of some of your own discretion. Reasonably possible is that the future event is more likely to occur than remote, but less than probable. And then remote, the chance the future event occurring is slight. So taking a look at example 8, it says Scorsese Inc. is involved in a lawsuit at December 31st, 2025. Prepare the December 31st entry, assuming it's probable that Scorsese will be liable for $900,000 as a result of this suit. Prepare the entry, if any, assuming it is not probable that Scorsese will be liable for the payment. So under the first case, you're going to have what, it doesn't tell us exactly, but we would say something like lawsuit loss. And then lawsuit liability for 900,000. And for part B, no entry is required. Any questions on example 8? All right, so now you have the next section that kind of explains what a warranty is. You have two types of warranties. You have an assurance type warranty, and that's that you don't pay any more or anything extra for it. It just comes with the product, and it basically says this product is going to work for 30, 60, 90, 120 a year, and it's going to do the things that it says it's supposed to do. So that's an assurance type warranty. That's implied, at least in the United States, for most products that you get. A service type warranty is sold separate, and that would be like an extended warranty that you pay for. And so that one does have a charge that comes with it, and the revenue must be recognized over the period which the service type warranty covers. So let's take a look at example 9. Leopard Company sells smart home systems. The corporation also offers its customers a 4-year warranty contract. During 2025, Leopard sold 20,000 warranty contracts at $99 each. The corporation spent 180,000 servicing warranties during 2025. Prepare Leopard journal entries for the sale of contracts. So we can do the first one first. So we received cash, and we received 20,000 subscriptions times $99. And so that's 1,980,000. And we have not earned that warranty revenue yet. So this is going to be unearned warranty revenue for 1,980,000. And so that's how our transaction would look for the first one. Part B says the cost of servicing the warranties. And so it says assume service costs are inventory costs. So we have to pay attention to this one because it applies for B. And so the way that they have warranty expense, it's all based on parts. And so they have inventory here for the credit. Usually you would have cash there if you had to pay service costs for 180,000. 180,000. And C, the recognition of warranty revenue. So at the end of the year or the end of the period, they're going to have a debit to unearned warranty revenue and a credit to warranty revenue. And the amount, we take the 1.98 million and we're going to divide that by 4 because it's a 4-year contract. So revenue, 495,000 per year. And so we have 495,000 and 495,000. Any questions? Now, there's just some information here on reporting liabilities on the balance sheet. Seen this before, it's nothing different here. The one thing that they introduced in this chapter to analyze the company's ability to pay, and I think we've talked about these in earlier chapters when we talked about debt, but the current ratio, current assets divided by current liabilities, and that's why when you can shift long-term debt out of that equation, it makes your current ratio look much better, right? Because you take it out of those current liabilities. And then if you really want to know whether or not the company is going to have cash without worrying about inventory to cover their bills, you look at what's called the acid test ratio. And basically it takes your current assets except for inventory and is the same number, except for it, of course, takes out inventory. That takes out some of management judgment, and it's a little bit better test of whether or not management can pay its liabilities coming up in the current year. Are there any questions? Okay, I have the chapter 10 in-class project. I'm going to pause the recording or stop the recording here, and we're going to work on the group project. For those of you that are online, hold on for 1 minute. I just went to try to post it on the website and realized I didn't save it on my computer, so I have to run to my office. But everybody else here will be working on the group project, and I'll be back in a few minutes. All right, thank you.